Hey everyone, thanks for joining me for the latest episode of the Financial Frontier. I'm your host, Patrick Camuso. We have a lot to discuss today in terms of news and headlines related to digital assets on the regulatory, tax, and accounting front. And I also have a few things that I want to hit on that I'm seeing in my experiences within my practice at Camuso CPA, where we work directly with Web3 businesses and digital asset investors. There's a couple consistent themes that I'm seeing that will help you out personally as someone in Web3, whether that's as a business owner, an investor, or an advisor. So I'm excited to cover these topics. Let's get right into it. I'll start by sharing my screen here and we could hit on some of these topics. So let's see. So let me just make sure my screen is sharing, and it is. So firstly, I just want to encourage everyone to visit my website at camusocpa.com. On a weekly basis, we put out a newsletter called the Digital Asset Digest that gives you a weekly update of the latest regulatory, tax, and accounting news, as well as timely tax updates and proactive tax tips so you can make sure that you're staying ahead of the curve when it comes to taxes and accounting in this fast-paced digital asset environment. So, like I said, this newsletter goes out every week. We cover a lot of the topics that we cover on this live, but we go into more detail, and then oftentimes I'll hit topics that we just don't have a time allowance for on these live videos. So be sure to check this out. There's a lot of valuable information on this. There's thousands of people subscribed, and you should join them and become one of them today. Other than the newsletter, on November 3rd, which is next month, I encourage you all to attend this LinkedIn event, the Crypto CPA Q&A. We have about 300, over 370 attendees right now, and it's basically growing every day, and I expect it to continue to grow as we start to approach the actual date of the event. What I'm looking to do with this is a little bit different than these live videos where I'm presenting a lot of information that I'm seeing in the news and in my practice. This Q&A, I really want to focus on your questions. There's many people that have already submitted me questions. I'm encouraging people to continue to submit questions in advance. And then during the call, you can also pop in and either comment or pop in on with your voice and ask questions then as well. So I'm really looking to address your pain points, your needs during this call. So definitely tune into this. I really think it'll be valuable for anyone that wants to get their cryptocurrency tax and accounting questions answered and addressed. So let's get right into some of the headlines I wanted to discuss now, because I do think that these are going to be pretty interesting. So this first one is out of Coinbase. And you'll see here, this has been something that's been getting thrown around for a while. Crypto wants a de minimis tax exemption in the US. So what does that mean? Right now, any transaction that you do when it comes to cryptocurrency is a taxable event. Even if you took, a small purchase like buying a cup of coffee or buying a pack of gum at a convenience store, if you were to complete that transaction in Bitcoin, Ethereum, or any other crypto asset, that's going to be a taxable event. So the reason why this is an issue is, going back to the Bitcoin white paper, peer-to-peer cash, really, one of the original use cases for crypto was as a peer-to-peer currency and a way to exchange value. So this tax structure with crypto being taxed as property, which leads to every single one of these transactions being taxable, is really prohibitive to the adoption and the use case of using crypto as a form of payment. So that's why we've seen this request and proposals for a de minimis tax exemption in the US. What this would effectively do is set a certain threshold to where if you have transactions at a certain threshold, those aren't taxable. Now, advocates of this will say that the goal is to basically allow people to start transacting in crypto, and the tax impact of it is negligible because the de minimis threshold would be under a certain dollar amount. Say the de minimis threshold is anything under $50, you don't have to track that transaction for tax purposes, but anything above that you would. And what this would do is help to allow more people to transact in crypto because they don't need to be worried about doing the accounting and filing the taxes for every single micro purchase that they make. So, we saw the Senate Finance Committee, Ron Wyden and Mike Crapo of Idaho, published an open letter in July asking the crypto industry to weigh in on this. We still haven't seen any de minimis rule applied here, but this is something that I would like to see just because, I've been an advocate of Bitcoin and cryptocurrency for so long. And I do think that this can help reduce some of the red tape that's preventing adoption in terms of a peer-to-peer exchange of assets like this. So we're still just sort of waiting to see if anything comes of this. Like I said, I've been seeing calls for the de minimis exceptions for years, and we still haven't seen anything. But I am hopeful for the future with this. But I wanted to bring up sort of another related point to this that I also think is interesting, and that is basically this is a white paper that I was reading with all these regulatory changes that we've seen over the past months. There has been so many tax and accounting white papers that are written in response to a lot of these requests for comments and accounting proposals. This one in particular is titled "Common Sense Recommendations for the Application of Tax Law to Digital Assets," and this is in response to the Joint Committees on Taxation in July 2023, which is basically related to some of this de minimis exception here, among many other things. So the one thing that I wanted to point on this that relates to the de minimis exception. So this does talk a lot about staking and a lot of other topics. I thought what they brought up here on page 8 though was very interesting in terms of some of the risk associated with some of the tax positions that many in our industry are advocating for. So this paper is a little more critical and aggressive in terms of its viewpoint on the taxation of digital assets, but I do think that there's some interesting points raised in this. So basically they're outlining a scenario here where us as the crypto industry sort of get our wish list in tax regulations. We get staking taxed upon sale rather than upon receipt. We get de minimis its exemptions to spending crypto. And he's basically going over what will this lead to in terms of the tax impact. So what this describes is basically a scenario where if all these aspects line up, you can actually be in a position where a taxpayer may never pay taxes on their digital assets. And the way that would work in this hypothetical scenario would be someone is staking, they get staking rewards, and the staking rewards are not taxable upon receipt. Now, please don't clip that because they are taxable upon receipt as of right now, but this is a hypothetical scenario. So in this scenario, if staking rewards are not taxable upon receipt, then basically those staking rewards, the validator can hold them until death and get a step up basis in those assets. So then when those assets are subsequently sold, there wouldn't be any gain realized on them at that point either. So you could basically be claiming these staking rewards, hold them to death, get a step up basis as a tax strategy. And then that tax strategy can take a step further if there's a de minimis exception, because then in addition to holding these assets for a lifetime to get that step up basis and to defer or never pay those taxes. Now with this de minimis exception, you can be using those staking rewards to pay for expenses that are under that de minimis threshold while still not triggering a tax liability. So, that's why here they say that, the non-taxation raises serious concerns for abuse. And, there's this risk that they're perceiving that's created with that. I think that even with the de minimis exception, there can be some provision carved out where, staking rewards get considered separately from that. But I thought this was interesting when I read this, because this was the first place where I've seen this fact pattern laid out like this. And I thought it was interesting. It relates to the de minimis. It relates to the staking taxation. So, it'll be very interesting to see where this goes. I thought this white paper was pretty good. There's a lot of contributors to it, so I can't really give credit to one person, but you'll basically see everybody that's listed here that was a part of this paper. So next, what I wanted to hit on was something that, I've been sort of warning about this, but I still haven't seen too many articles or headlines on it. And I saw this one come out recently, so I thought I'd mention this. Beware of investing IRAs in NFTs. So people, they've been viewing IRAs as a good vehicle to put digital assets in, because it can be self-directed and there's obviously tax benefits associated with it. The problem is that we've seen the IRS indicate that some NFTs, depending on the underlying nature of them, are going to be taxed as collectibles. Now, collectibles are actually not allowed as investments within self-directed IRAs. So there can be this issue where, people, if they're just looking at digital assets sort of generically and they're not differentiating between specific NFTs based off of the underlying nature, or not even distinguishing between NFTs and fungible tokens, then they can run into a huge tax issue where they put NFTs into their IRA, and then what they're going to have is a forced distribution with the associated taxes and penalties associated with that, because that transaction and that investment is not allowed within the IRA. So this is something that you really want to watch out for. You want to avoid these types of prohibited transactions, so you don't run into these unforeseen tax issues and also lose money to penalties. So this is something very important to consider, and it's something that you want to be very proactive in your considerations if you're explaining this to clients, or if you have a self-directed IRA yourself. You don't want to wait till it's too late and you have one of these NFTs sitting in your IRA, and at that point there's really not much that can be done. You're going to be stuck with the unforeseen tax issues associated with that. So those were some of the headlines that I wanted to cover. I thought that those were some interesting points, but there's also, some themes that I'm seeing consistently in my practice at Camuso CPA on a weekly basis, almost on a daily basis, basically anytime I'm talking to a new potential client. And that is that they're not doing proper due diligence on their portfolios and their accounting records, specifically on their ending cost basis data. So what's happening is someone's coming to our firm and they want to work with us. They may have been self-calculating using one of the crypto softwares, or they may have been using another CPA firm. And really one of the first steps if you're working with me is that we're going to have to see your detailed ending cost basis data and get that information as of your last accounting period into our accounting system. Now, what's happening is a few things that are all related to this detailed ending cost basis data. Number one is oftentimes I find myself as the first person explaining this to somebody, and they just didn't even realize this. If they were doing this themselves in a software, they didn't even consider this. If they were working with another CPA firm, this was just never explained to them. And in many cases, they were not even given the ending cost basis data at the tax lot level that's required for them to basically go to any other software or any other CPA firm. So in many cases, they don't even have the data. So that's a huge issue right there. And then another very common thing is even if they do have the detailed ending cost basis data, some softwares and some providers are only just giving them a summary version without the tax lot level details in it, which also is not going to be able to be used to roll you over into another accounting system, because we need that tax lot level detail at the ending cost basis so we can build an audit trail for subsequent purchases and spending and sales of those assets. So really the first thing you want to watch out for when it comes to your detailed ending cost basis data is your data being held hostage by either CPA firms, accountants, tax softwares, accounting softwares. You want to make sure before you even start going down a road of working with any of those service providers or software providers that they're providing you the right information. So you want to make sure of that up front. So that's the first hurdle. You got to just get the data. After that, you're still not totally in the clear, because that's really step number one. The next step is that data has to be accurate. So it's crucial that you do your due diligence on that data. I will say that at Camuso CPA, when we're working with the client, the chances that when we send them the first draft of our portfolio calculation before doing our ending due diligence process with them, the chances that we're going to have that 100% accurate are extremely low in most cases. And that's just because of the overall complexity associated with the accounting. And I say this to really drive home the point that doing proper due diligence is the key to ensuring accuracy on the portfolio. And one of the big steps to that due diligence process is taking the calculated detailed ending holdings and comparing them to your actual ending holdings. This sounds like a very simple step, but for some reason it's going overlooked at such a substantial rate. I'm appalled at it. So you need to be looking at, if you calculate it at the end of the year that you hold 30 Ethereum, and actually at that date in your wallet, across all your wallets, you held 40 Ethereum, that is an issue. And even if the rest of your calculation looks correct, that is going to be an issue that hurts you from a tax perspective, either in the current year or in a future year when you go to sell those 10 Ethereum that are not reflected in your ending holdings. So you need to make sure that you're getting this data, and then you need to make sure that you're doing your due diligence on this ending cost basis data. And there's many other due diligence checks that you should be doing, but this is one in particular that's going largely overlooked. So the reason why this goes overlooked, I mean, I most people when I talk to them are just completely unaware of this. They don't. Firstly, many of them don't really realize that there is this cumulative nature to tracking your cost basis data to where, from your first trade to the current period, you may have been purchasing assets. Say maybe you purchased Ethereum in 2018, you purchased more in 2019, all the way through 2023, and you've been buying and selling each year. There's a cumulative nature to tracking that basis all the way from the first purchase through to your last purchase or sale. And many people just don't realize that there is this cumulative nature to tracking it, and that if you're inaccurate in a prior year, it can affect you in a future year. I do see many people that come with the belief that, yeah, I just had losses last year. I bought some crypto, but really, this tax year is the year I'm really worried about because I have some gains. That may be true, but you have many purchases and transactions before that, and to accurately calculate those gains in the current year, we need to go back in the prior year. So I think there's just a lot of people that are still unaware of the nature of this, and apparently, that extends not only to potential clients, but these a lot of times where I'm seeing this is these clients are working with firms and or softwares, and this is still going overlooked. So I think it's just a huge issue where people are not realizing the importance of verifying this ending cost basis data. And it's just something I find myself cleaning up a lot lately, a lot. So that's just something that, I'm seeing consistently, and I want you to keep in mind and to factor into your due diligence process. Now, overall, the complexity associated with accounting for digital assets, as you can see, is going to continue to increase as, for tax purposes, we start defining these different types of assets, such as, separating NFTs, where some of them are going to be taxed as collectibles based off of the underlying nature, and looking at many of these new tax considerations that are coming as a result of the tax changes that we're seeing. This is just going to accelerate, and the need for people to accurately do their accounting and taxes is just going to grow. So you need to make sure that, if you own a Web3 business, or if you're a digital asset investor, you need to make sure that you're closely working with someone that is experienced with this and is staying on top of it, because the complexity is just going to continue to grow. As entrepreneurs, business owners, and investors, sometimes taxes and accounting can get left as an afterthought, but that is the last thing that you want to do in the digital asset space, because there is a high level of complexity. We're on the financial frontier, and we need to make sure that we're being proactive about this to protect your assets. An example that I've encountered recently is that there's still many people that, in addition to, working with firms that are not doing their due diligence, there's people that are still self-managing complex accounting and tax functions for their portfolios and their businesses. We recently onboarded a fund that any given year does 50 to 100 million transactions. So that's an algo trading fund. And before they worked with us, they were self-managing their transactions, if you can believe that. The level of complexity associated with that, it's just not something that you should be self-managing. The potential issues associated with that are huge. Even if you're able to wrangle your data and get your accounting somewhat accurate, there's so many tax considerations associated with your transactions. You need someone that's on top of this, that's making sure that you have a sound accounting process, that you're documenting things for tax purposes, and that there is a very strong due diligence process to ensure accuracy across the board. So those are some of the big things that I'm seeing within my practice. So there is many more things that I do want to cover. Some of those things I posted again in my newsletter, the Digital Asset Digest, and some of these things I'm saving for next week's live. Next week we'll go over more headlines, and we'll go over just some more issues and some more things that I'm sort of seeing industry wide when I'm consulting to clients and I'm speaking to new potential clients each week. So that's all that I have for this week, and I appreciate you taking the time watching me here. I really enjoy giving these talks, and I hope that you got some value out of it. Until next time, I'm Patrick Camuso signing off.